short while ago, did we not? If we've got a 50 at the money strike, here for example, the idea is that we should trade according to the probability. Now, where does probability show up? Probability shows up on this axis here. If this axis is going higher, then this is effectively the probability distribution telling us that there's a higher probability, right? So this is the probability axis here. Obviously, the other axis is simply the deltas involved in this trade. So obviously, if I show you a delta, let's assume the at the money is this price here. So if I show you a delta that does that, and a delta that does that, then of course, there's no probability of the price going lower and a very high probability of the price going higher. If that's doing that, even more higher probability of the price doing higher, correct? Even more probability. So obviously what I'm looking for is I'm looking for this dark green line. I want to know what my probability is, and I want to know what the overall shape of this is in the last couple of days. So you can see that the dark green line here in terms of new actually dropped off here, and it also kind of dropped off here as well. Initially, this was bearish, but it went into a neutral kind of look. So that's obviously them taking away the bearish skew. So in respect to the fact that they took away the bearish skew, there's a little bit of upside, I think, on this trade. So in other words, if I didn't get a trade on DLO, I'd possibly take the play on new. I don't really want it. I don't think it's got a lot of upside, but I would still take the play on new. It's not ideal. It looks like it's a 50-50 toss of a coin type trade. If I didn't have that drop off there, there would be no edge whatsoever. But obviously, when I'm looking at this one here, I'm now looking at DLO. Well, you can see there's a big difference in DLO. First of all, we lost a little bit of quality because obviously this rallied off the bottom edges here. So that's obviously adding a little bit of bearishness. But then, of course, you'd imagine it's going to add some bearishness because it's the very high volatility, very high implied volatility earnings release. So, of course, there's going to be some bearishness. I just want to know whether the bullish is higher than it was and whether it's higher than this one. And the answer is yes. So when I'm looking at this, DLO is my selection to trade. DLO is my selection to trade. So obviously when I look at that selection to trade, and I know that obviously during the course of the day, I watch the up-to-date gammas on this, I look at the skews on this, I look at the thetas obviously coming into play. I think about basically all the Greeks at this stage. I'm trying to see the skew evolving, but obviously if you want to just do it as a baseline, then of course other things you're looking for is things like volumes. You can see on this candle here, there was a sudden big surge of volume just before 8:30 last night. You can see that that big surge of volume also had a very large pin attached to it. This was also coming into a prior swing. It was also coming into the $13 price level. So obviously we can start to recognize the massive volume and it's starting to hold the price. So this is now telling me that I've now got a buyer showing up on this stock. A buyer showing up on this stock. Now there was obviously, I think there's going to be an investigation into this, right? You may say, why do you think there's going to be an investigation? Because take a look at what happened. This is not the closing bell. This is not the earnings report. This is not the earnings report. So somebody somewhere got an awful lot of inside information before the earnings came out. Now, obviously, you might argue that it's just somebody doing exactly what we did, and that is buying up all this stock before the earnings because we've got the skew right and everything else right. It might well be that the market maker sees this type of skew and starts to buy up loads of stock on the basis that it hedges their upside risk, right? It hedges their upside risk. Imagine Abs just bought a couple of £1 million worth of, or a couple of $1 million worth of DLO call options. Well, obviously, if the dealer's going to hedge that call option, the dealer has to come into the market and buy loads and loads and loads and loads of stock. Yeah. So obviously that means that there's a story building here. The good news is we're ahead of the story. The bad news is if you wait to the cash close to get the trade done, you've obviously just paid a massive premium on that deal. Not a lot of premium, but you've gone from $13. By the time the cash market closes, it's at $15. It's already up $2 on a $13 stock. That's a pretty big move, isn't it? Anyway, so what happened to the stock yesterday, of course, is quite exceptional. This is what happened to the stock yesterday. So we were obviously snapping up all the bottom edges at $13.10, buying quite nicely at $13.10. Somebody stepped in early and took a jump at it. And then, of course, when the earnings hit, the price traded up to a high pin, started to pin into the $20, the $21 rally. So we went from $13.50 to $21. A profit of $7, which is over 50%, of course, return on investment on that particular trade. And we only had two trades yesterday, didn't we? We had New and we had DLO. So, you know, it was obviously a good play. It was obviously played out quite nicely. And obviously, if you've got a leveraged account, now, Kim's mentioned before, if you've got a leveraged account, there is a little thing called the day pattern rule. Has everybody heard of the day pattern rule? It just sets boundaries. It sets boundaries on the size of account you've got to have. This does not, and then somebody might be able to correct me in the States if I'm wrong, but this does not affect cash accounts. So if you just go in and buy the shares, you can trade all you like on the day trading idea. It doesn't affect you in any way, shape, or form if you're just going to pay cash for these things, right? The day pattern rule is if you're trading on margin, you've got to have a lot of money on margin on that trade. Yeah. So obviously, I think am I right? I thought at first I thought it was 50,000, but somebody reminded me it was only 25,000. But anyway, you still have to have $25,000. You have to have $25,000 on account to trade on margin in the stock markets. Okay, on margin in the stock markets if you're going to take these short-term plays. But if you're trading stocks for cash, you could have a $5,000 account and you could have bought a lot of shares there, and you'd have made yourself about $3,000. That's not a problem, guys. That is not a problem. Now, to be completely honest, this is bigger. The percentage move on this is the biggest we've had this year. You know, so it's not the norm, and I'm not claiming it is. This is the biggest move we've had this year. The implied volatility in this was only 15%. The up move was 60%. So you can see it was way more than anybody that actually imagined. And that's probably why there was such a big upside, because the dealers were just wrong on their implieds on this. They're going to be wrong. Nobody's going to have an implied of 60%. So they're going to be wrong on their implieds. The resource for Skew data, well, you can use bar charts for free, and you can watch the Skew data coming through on bar charts. You can obviously pay for Thinkorswim. Thinkorswim gives you up-to-date skews. Thinkorswim gives you up-to-date graphics on any of these. You could obviously pay for Reuters. If you wanted to pay for Reuters, you can get up-to-date skews on that. Or if you want to get end-of-day skews, you can pay for Spot Gamma. Spot Gamma. But they don't do intraday skews. They only do end-of-day skews. So you can obviously make your choices about what you like. But bar charts is free. Jack's just mentioning that TOS is free as well. The downside of TOS is, I think they don't open for anybody outside the US. Is that right? I think you've got to be in the US to get a Thinkorswim account. But does everybody agree that that's a good? Does everybody agree on the storyline here? I mean, because we've covered this storyline before. It's not like it was a one-off. You had the information before the earnings, after market. This was at 2 o'clock before the cash open. So you literally had the entire US session to be looking at these two stocks and watching these two stocks and trying to figure out whether these two stocks had any value for you to go in and take a buy-side pop at any of this business. And obviously this was your selection because it was the only one that did have a clean bullish read. So, for example, if you look at today's trade, which is Stone, STNE, there's no bullish read on this at the moment. There might be a bullish read by the end of today. There might be a bullish read by the end of today, but at the moment, there isn't any bullish read on Stone. I'm not going to be trading Stone for the earnings report. So I don't have a play this afternoon. I don't have a play this evening in terms of the stocks, but do I care? Not really. The last three picks we've had, we've done 20%, 25%, 5%, and now we've just done 60%. So we've done over 100% return on account in just the last 4 trades over the course of the last 10 days or so. 100% return on account. And that's not bad for a non-leveraged, non-margin stock trade. It's not a bad way to make a living, guys, because you're not exposed, remember, to the underlying stock market. Is it a gamble? It's an earnings report. So, of course, it's a bloody gamble. So we've got to bear that in mind. We've got to factor that into your considerations in terms of what you trade and how you're going to trade it. And just trade it as you go. Our bond, unfortunately, we got busted on the bond. We've ended up scratching out at +1 and scratch on the bond. The curve just collapsed behind us. The macro is good, so I'm not going to be against picking up some more business at deeper discounts. The deeper discount that I am looking at is the price we call the guaranteed discount price, and that is 28. So I'm not going to be put off being a guaranteed buyer at 28s. So just if you're watching for possible plays, 28s is the price I am looking at for a guaranteed discount on bonds at the moment. Did you all see what happened to the oil when it came off that bid? Remember, we shouted that we should mark off the bids at 80.83, 80.84, 80.85. Look at what happened to oil. We said bag and tag your money here because there's already seen these bids. The market's in a buy trend. So there's a very good chance that these bids will come back out to play. The price is bounced off 80.83s. It's traded back up to 81.10s. And that would be a horrible giveaway for your profits if you never took your money at that stage, correct? Beautiful. Absolutely beautiful. So well worthwhile paying attention to these areas. You can see that these are not hindsight pieces of information. These are on the charts before it happens. There it is there. You can see the bids were already on the charts in there at 153. Way before 2 o'clock, 2:30, right? Way before 2 o'clock, 2:30. So you can see that this is not hindsight information. This is on the screens already, ready to use, ready to make decisions against, and then you just kick in. If you're trying to get a trade-off, that's the place to get the trade-off into. Well done, guys. Good bit of business.